the quick 1 minute lesson on budgeting? Emergency fund. My question is, where do you park it? Are you keeping this in a savings account, in a high yield savings?
Rule of 72, where you divide the number of 72 by your return. Let's say you have a 10% return on your retirement assets. It will double every 7 years.
You see thousands of tax returns every single year. What are the top 3 things that the wealthy...
A vast majority of my wealthiest clients are invested in.
Welcome to Office Hours, a tax podcast by Fujikawa Associates. And we're your hosts. I'm Josh Baldovino, one of Derek's clients, and this is Derek Fujikawa, and he's the managing partner of Fujikawa Associates. Derek, I'm excited today because we are talking personal finance, and we're going to get a little personal because I do want to hear your approach. I know that you own the accounting firm with your dad.
Yes.
You have some, let's call them young adult children now. And so I'm curious, as a young dad myself, how you teach your kids finance, and we'll just dive right into it. And
Sure.
I'm going to start personal.
Okay.
How did your dad teach you about how money works in personal finance?
Yeah, it wasn't really a direct conversation, but I started working with him in his office, actually really young, probably in elementary school.
Okay.
Yeah, I would go in and just sort things or file things. And then as I got older, he gave me a little bit more responsibility. And then he would pay me a wage and I was responsible for that. So I don't know. It wasn't really so much sitting down in a conversation, but more of a practical thing where I was responsible for certain tasks. And I got paid for everything and I had to budget my money. I probably didn't do a very good job of it at the time, but it was a practical experience. It stuck with me.
Was there a specific lesson or philosophy that he had towards money that you remember?
I don't know about a specific philosophy. He was an accountant too. We worked together for years, but just the importance of keeping track of everything, right? I think that's where I got my almost OCD level of making sure that everything ties out. Right? I have no variance in terms of, I need to make sure that everything ties out to the penny. Otherwise, it'll bother me and I'll go back and do it anyways. Even if I know that I can round to the nearest dollar, I'll go in and make sure it ties out exactly.
Okay. In terms of rounding and tying out, let's jump into the first concept I want to dive into, which is budgeting.
Sure.
In general, how do you approach budgeting? If you were to reteach your kids how to budget, which I'm sure they're pretty good at, what's the quick 1 minute lesson on budgeting?
It is pretty simple, right? Just don't spend more than you make. So really see what you're making and then start from there. Don't start from how much you're spending and try and make that much. You've got to look at how much you're making and a realistic look at how much you're making. Your salary might be $2,000 a month, but you've got taxes and insurance and things like that you have to pay. So you have to make sure that you factor all that in, and then whatever's left over, that's what you have for your discretionary use. So really making sure you have a realistic look at your income and what you're really taking home from your job.
Yeah, that is a harsh reality when you do.
Definitely.
You get your, here's my expected salary. And then after everything that comes out, you're like, wait a minute.
Yep.
Half of it's gone. Where did it go?
Yeah.
And I always felt it interesting how you have the income that you earn on a top line basis. And after everything's removed, yet if you're going to go and get financing for a house or for a car, they take top line and not net.
Yeah, it is interesting that they do that.
I guess it works in our favor to maximize the borrowing power, but
yeah, I guess it's the most universal number, right? Because everyone has different amounts taken out in tax, or you could play around with the take-home number if you really wanted to on your paycheck. You could take out very little in taxes and then owe a ton at the end of the year, so you could look like you're taking home a lot of money, but in reality, you're going to just owe that money at the end of the year. So I guess that top line is the easiest to match up to everybody.
For sure. Yeah, and a personal rule for me for budgeting, and I guess I've started doing this in high school, and it's kind of just stuck with me ever since, but I always calculate how much something is in terms of how many hours I have to work.
Yeah, that's a good way to manage it. Is it worth all these hours to do something that you really want to have or do? Is it worth all those hours to actually spend all that money? So it's a good kind of little check on that.
I know, and I had some fun. I don't know if you saw a post that I did, but I did something where the average Super Bowl ticket was like $9,000.
Oh, yeah.
And even if you made, I don't know, I forgot, it was like $100,000 a year, you're still working for like 3 weeks or something like that.
Yeah.
To buy
Yeah.
a Super Bowl ticket. And you're like, man,
that's crazy.
I don't know. Okay, so that's budgeting. Emergency fund. How do you approach that?
So in general, I would say the minimum would be having at least 2 months of your living expenses. So rent, food, maybe not your discretionary stuff, but all the necessary expenses that you have. Ideally, you want to have 6 months, but I would say minimum, if you can swing it, it would be 2 months of just emergency fund. If something happens, if you were to say lose your job and you had to look for another job, or if you get sick and just can't work and aren't getting paid or for a certain amount of time, that gives you a little buffer in order to weather that versus having to say go into debt or borrow money or not pay your bills for a month, take a big hit on your credit. So that is something that's important. I know it's difficult when you get just starting out, if you're in a relatively low paying job, but if you can be really diligent about it, even just setting aside a little bit a month, after a year or so, you're going to have at least something built up and be able to use that if and when the need arises.
Okay. Yeah, I mean, once for sure is minimum. Six
Yeah.
months, a year would be awesome. My question is,
Yeah.
where do you park it? Are you keeping this in a savings account, in a high yield savings? Is
Yeah, you want to keep it in something that is secure, right? So you're not going to want to throw it into a tech stock and let it ride the market. You don't want it to be in something that could be down significantly when you actually need the money. So you want it in something that's secure. So yeah, generally some sort of bank account or something. Yeah, you want something that earns interest, so you're at least earning something on it. It may not be a lot, but something that's going to be there, that's accessible, that's liquid. You don't want to put it into, say, a CD that will have penalties to pull out. So you want to have it in some sort of account that's liquid and, yeah, ideally earning at least a fair amount of interest.
okay. Let's talk about the not fun stuff now. And I feel like it's very hard to save for an emergency fund, especially with certain debts that you have.
Hmm.
Like student loan payments can be big, especially
Yeah.
now. You went to USC,
Yeah.
and if you took loans for that, it gets expensive. You went to grad school, and those grad school interest rates are no joke.
No.
So I guess, what
Yeah.
is your thought process on mitigating debt? Are you on the Dave Ramsey debt snowball, just tackle the lowest one first? Are you going straight interest rate? How are you tackling it?
Yeah, I would say go for the whatever has the highest interest rate first, right? Because yeah, obviously that's going to build the most. So
Mhm.
the faster you can pay those down, then the less interest you're going to be paying overall. So definitely want to tackle those first if you can. And really just, yeah, making a plan, not just throwing money at it when you have it, but try and make a plan, be diligent, make it part of the budget that we were talking about.
Mhm.
Put that into your budget so that you're making that a priority versus, oh, if I have enough money left over, I'll pay some down. Make that a priority as part of your fixed expenses so that you're making a serious dent in those loans.
Yeah, definitely. I mean, listen to this and you have credit card debt, pay that off first, because those things
Yes.
are 20-25% interest. And essentially, if you're just making minimum payments, you will never get out of it.
No.
Now, as you pay off debt, which is good,
Mhm.
build some savings. And the next part that I want to think about is what? Retirements.
When you're just getting out of college or just getting started, that's the farthest thing on your mind, right? That's way out there. But that's the best time to really put money in because you have this huge asset, which is time. If you're just coming out of college and you put $1 into your retirement fund now versus myself, who's on the closer end of retirement, that dollar is going to be worth a lot more by the time you hit retirement than it will be when I hit retirement. So whatever you could put in, even if it's not a lot, it just start adding to it and it's just going to build upon itself. So there's this, I don't know if you've heard the rule of 72, where you divide the number of 72 by your return. So say you have a 10% return on your retirement assets, it will double every 7 years. So you put in $1, 7 years is $2, and 14 years is $4. Now make that $100 or $1,000. It's going to keep doubling every 7 years. If it's 10%, whatever your return is, whatever that increment is. So the earlier you start, the more that's going to keep compounding and get bigger for you. So you have that, the time is on your side in this case. As much as you can put in, get started as early as possible.
So, and that last double ends up
Mhm.
being huge, right? Like if you
Yes.
all of a
Yeah.
sudden,
Yeah. Yeah.
let's
I
say
mean, even
you have,
just stick with $1, right? 1 to 2 to 4 to 8 to 16 to 30 just keeps getting bigger and bigger. So yeah, the longer you keep it in there, it's just going to keep expanding.
but it's very hard to think about it in that sense. What is
Yeah.
your, like, at a bare minimum, try your darndest to save? Is it like at least max out your Roth IRA? Is that the bare minimum,
Yeah.
like in your 20s?
Yeah. So I guess it depends. If your company has a match program for their 401k plan, the bare minimum is to contribute as much as they're matching.
Mm-hmm.
So,
Because
so say they match like 3% of your wages, right? Then you're going to want to at least contribute 3% because they're going to give you that they're going to match that for free.
yeah.
So if you're working for a company that does that, then that should be the bare minimum because, yeah, like I said, that's just free money that they're giving you. And then, yeah, on top of that, then whatever you can afford to live, not comfortably, live within your means.
Yeah. And we're now getting into a little bit of, you have a job, maybe you're
Mhm.
filling out your HR paperwork and all of these things starting you at once. It is the most, I remember. It's the most confusing thing ever. My wife still doesn't
Yeah.
even know what to claim. Is it one? Is it zero? I don't
Yes,
know.
yes.
Let's talk about those taxes and withholding as you fill out that. Like
Yeah.
on a blanket statement, obviously it all depends. But if
Mhm.
someone is you college grad, mid 20s, what should they put on that?
Yeah, so they've changed that quite a bit. It used to be pretty simple. You just put one exemption or one dependent on there and you're done and that's easy. But you almost have to do a mini tax return on it's called the W-4 is the form that you fill out to calculate your withholdings on your paychecks. And now it's a whole bunch of boxes. You got to fill in a bunch of numbers. If you only have that job, it's relatively not easy, but easier to fill in because you have all the numbers there, you know what you're going to make, and
Mm.
you can just plug it in. But if you have two people working and you have other investments or things like that, then it can get really tricky kind of filling that out. And you almost need the help of somebody to get those numbers for you. But yeah, if you're just starting out, it's like I said, it's relatively simple because if you just have the one job, then you have all the numbers there.
And then what about health insurance? Because there's a million different options.
Mm-hmm.
How does that affect you tax wise, income wise? There's high deductible, low deductible. Like break down that down as if you were again explaining it to your kids.
Sure. So there's different options. The traditional is just the regular health insurance. You pay X amount a month. You have a relatively low deductible, anywhere from 100 to usually about $1,000. The deductible being the amount that you're going to pay out of pocket before the insurance starts paying your bills for you. Yeah, obviously, the lower the deductible, the higher your monthly payments are going to be. The insurance premiums are going to be because they'll have to pay more if anything happens to you right off the bat. The other option would be, if you're talking about high deductible plans, there's what's called a health savings account, which can be a very good option, especially for younger people. You buy a high deductible insurance, so $2,500 deductible or more. So meaning that if you get hurt, you're probably going to have to pay out of pocket. Or, if you have to go to the hospital or do something, you're going to have to pay out of pocket quite a bit up front before the insurance kicks in. But with the health savings account, you can put money into this health savings account tax deferred. So it's pre-tax. You can either do it through your employer if they have a plan, or you could do it separate on your own. You put the money in. You could put up to, it's about almost $4,000 for an individual, and double that for a family. And that is a deduction off of either your wages if you do it through your employer, or it's a deduction off of the top of your tax return. And then for the federal, California actually doesn't recognize it. They don't conform to that law, which makes it a mess. But the California tax rate's much lower, so it does hit you there, but not as bad as on the federal side. So you can put this money into this health savings account pre-tax. Now, if you do need to use your health insurance, if you do have a medical issue that is below your deductible, you can use the money in that health savings account to pay for that. So you're getting a deduction for these medical expenses. Medical expenses are an itemized deduction, and most people, a vast majority of people, can't deduct them because there's some high limits on them.
Hmm.
But this is a way to circumvent that, where you're getting a deduction for these health savings account contributions, and then you can use the money in there to pay your medical expenses. And as long as you pay the medical expenses, the distributions are not taxable to you. So you're essentially getting a deduction for those medical expenses.
On a blanket statement, I know this is the hardest thing to do.
Mm-hmm.
And this is assuming that someone has the means and discretionary income to also save.
Mm-hmm.
Obviously, again, it depends
Yeah,
for
yeah, yeah,
sure.
yeah.
What's a decent benchmark of how much they should contribute to a HSA?
You want to ideally at least contribute up to your deductible.
Okay.
That way, if anything does happen, you have the money there and are
Yeah.
able to use it. The HSA funds, it just keeps rolling over. You can keep contributing every year. And then if you never use that money, you can take that out once you reach retirement age. And it's going to be taxable because you've been deferring it, but there's no penalties when you take that out. So it's almost like a separate retirement account, like another IRA that you can add to. So say either you don't qualify for an IRA or you're maxing out your IRA. This is another way to put more money into a retirement vehicle, assuming you don't have any major medical expenses along the way. You could use this to keep adding money. So like I said, it's great when you're young because most young people don't have a lot of health issues, right? So you can just keep adding to this and create a secondary retirement account.
Can you invest, say, in real estate with an HSA?
Not with an HSA. With an IRA, you can, but
I've never thought about it from HSA.
yeah, yeah, yeah. I don't think so. I'm pretty sure because most HSAs it has to go into an
Health.
HSA account. Yeah, a health savings account. And so it's not like a self-directed IRA where you have total control
You can
over
pick.
everything. This is more of a specialized account.
Okay. Let's talk about now thinking about ways to build wealth, right? So we're
Mhm.
talking about personal finance 101.
Hmm.
but thousands of tax returns every single year.
Yes.
What are the top 3 things that the wealthy are doing?
In no particular order, but one is saving for retirement. That's a big one. Another thing is, as a CPA, I see a lot of tax returns, and I know I've mentioned this a number of times. I don't know, but most of my wealthy clients are invested in real estate. I'm not saying that if you invest in real estate, you're going to be wealthy. You have to be smart about it, but there is a correlation there, right? A vast majority of my wealthiest clients are invested in real estate in some way or another. And with leverage, you can get into real estate with a relatively small amount of money compared to the asset that you're buying.
Mm-hmm.
And then your returns are based on the total asset, not the money that you put in. So it can return quite a bit more than, say, other types of investments. Not to say that other investments are bad, but real estate has a way to really charge those returns. Again, you have to be smart about it. You have to do it right. I've also seen people lose a lot of money in real estate, so it's not just a guaranteed that you're going to be wealthy if you buy real estate, but that is a great vehicle if done right.
So retirement, real estate. What would be number 3 on your list?
Just investing in general, just setting money aside, right? It doesn't necessarily have to be in retirement. In real estate, and you definitely want to diversify, right? In real estate, you don't want everything in,
Mm-hmm.
say, stocks or even one particular stock, right? So you want to have a pretty well balanced portfolio of assets. If you get to the point where you can begin investing and spreading things out, you want to be diversified. If the housing market has a hiccup, then maybe other areas that you're invested in are still doing well.
Okay. Okay. I went to the last part for this episode, which is
Mhm.
continued education. So I want different benchmarks, right? Let's say
Mhm.
early 20s. What's the one resource, one book you think that they should read?
One book, something I don't know if this is controversial or not, but
Say it.
like the Rich Dad Poor Dad book, right? That kind of
Yep.
talks about the real estate and how real estate really differs from other types of investments. And even if you don't get into real estate, it's a good education and learning on how it works and seeing how real estate can really grow your net worth.
Yeah. I would second that. Rich Dad Poor Dad is the switching the mindset of how money works.
Yes. Hmm. Exactly.
On a very, I'd say that's almost like a 201 for me.
Hmm.
And another summary of kind of everything we talked about is a new finance influencer. I wouldn't call him, he's an
Hmm.
author, but his name is Ramit Sethi. I don't know if you heard of him.
Okay.
He's actually based out of
No.
San Francisco. Uh,
Okay.
and he has a Netflix show all about personal finance and how to
Oh,
manage
okay.
a lot of
I'll have
debt.
to check that out. Yeah.
But he wrote a book, I want to say it's almost 10 years ago now, called I Will Teach You to Be Rich.
Hmm.
And this was his basic personal finance philosophy. A lot of what we covered right now. So
Yeah.
in a very digestible way. So
Hmm.
that's, I think those two are very good entry points. What about now,
Yeah.
say you're going to mid-career, entry level, you made some money. What's the next? Maybe you have a family.
Hmm.
What's the next level of books or resources that you'd recommend?
I don't know about books, but as you get into a family side, then you got to start thinking about education, right? Your kids.
Mm-hmm.
And then you start thinking about estate planning and college planning and transferring your wealth. I don't know if I have any specific books that deal with that, but that's the next kind of evolution, right? Once
Yeah.
you're established, family, married, building up, that's the next step from the basic side is getting into those little more complicated issues.
I think actually those would be 2 good future episodes that we do. So you can let us know, audience
Right.
down below. Do you want us to film a how to pay for your kids' college next, and what a different way that you can pay for them, all through
Yeah.
the 529 accounts, or buying a rental property, which some people do
Mhm.
now too, or estate planning. Actually, we already have one, so I'll link one of
Yeah,
those
we do. Yeah. Yeah.
episodes down below.
Mhm.
But last question I got for you, Derek, and then we'll wrap this up. What's been your all-time favorite personal finance advice, the wisdom, saying of all time?
Yeah, I think what we had touched on earlier was the emergency fund. That's always stuck with me, even though maybe at times I haven't followed through on that. It is something that's really important. We've been fortunate enough to not have to use an emergency fund, or at least much of an emergency fund, but it's definitely something that is really important, and
Yeah,
something that I want to make sure that our kids understand and keep in mind as they move into the workforce and have their own families and things like that.
totally, totally. I remember being in college and I didn't have enough money to replace my tires, but it was raining much like it is today, and I
Yeah.
hydroplaned. I remember my car going
Oh,
sideways,
oh
and I
man.
was like, "Oh, I knew I needed to replace my tires, but I didn't have the money." And I went to my dad and I said, "Hey, Dad, I just hydroplaned. Could you pay for my tires? Because I don't have an emergency fund." Luckily, he helped me out. I know everyone's in
Nice.
that position, but ever since
Yeah.
then, there's a baseline necessities that I knew that I always needed to have money to pay for because
Yeah.
I do not want a hydroplane.
Oh.
Yeah, and for me, as I think about teaching my kids about money, I was
Mhm.
trying to break it down. At the time, Ezra was 3, and I said, "What's like the easiest way of teaching him how I think money works now?" And
Mhm.
I framed it as you make money, you
Mhm.
invest your money, and then your money makes money for you.
Mhm.
And that was like in the most simplest forms of what I was trying to do. And I was like, man, this could be a fun children's book to write.
Yeah,
I could
yeah.
figure out a way to flesh this out.
Yeah. It's gotta put colorful animals in it or something so that they'll,
Yeah.
stay there, keep their attention.
Different ways to think about personal finance. But Derek, thank you for breaking it down for us.
Sure.
If you are watching this and you made it this far, let us know what were either your major takeaways or what's your major money philosophy, because we'd love to just see how you are just thinking about personal finance, thinking about investing. If you want to connect with Derek and you want to buy rental properties or talk about your retirement plans, I will also leave Derek's contact information down below. But Derek, I appreciate it. Thank you
Yep.
so much.
Thank you.
And I'll see you all on the next episode. Bye, guys.